In today's lesson, I wanted to go over a common scenario I see with construction companies involving total estimated cost. A lot of companies tend to keep the estimate at the same amount the job was bid at, regardless of what changes have occurred since then. The scenarios may have changed. There may have been some cost savings that will end up turning into profit, but that's not adjusted in a timely manner. In this example here, this line here, row 6, we have such a case. The project amount was $1 million. The estimated cost was $950,000 at year end in 2024. Overbillings were $251,000. Now, fast forward to the following year when the project is complete. Obviously, no whip on completed projects. However, we see a decrease in estimated costs of $250,000. Sometimes those decreases are unknown. We don't know until the very end or close to the end we'll have significant cost savings. But there are many scenarios where we're aware of these cost savings, but nothing is done about it. So whatever that estimate was at the beginning sticks with the project until it's closed. And that's not correct. You should be updating those estimates as the job progresses. Things change. Again, the scenarios change. You want this to reflect as close as possible to what the job is actually going to close out. So you don't postpone revenue recognition. And the way to demonstrate that is to look at an as if or should have been scenario where we adjusted that estimated cost to what we thought it would have been in 2024. So instead of $950,000, we decrease it to $700,000. Everything else the same as far as bill to date, cost to date. That overbilling of $251 decreases to $120,000. That's a $131,000 difference. That difference affects your current liabilities, your working capital. That's a huge amount. Not only that, but that affects your income as well. Your gross revenues should have been $130,000 more. But since you stuck with the estimate that you had at the beginning of the job, not even thinking about changing it, you carved out $130,000 in revenue and working capital. Again, this is important when you're aware of these cost savings. You have to ask that question over and over again to project managers. Are these estimates updated? I know what it was bid at the beginning, and you may say, yeah, we're on schedule to make that. But there's so many scenarios that happen involving project managers saying, yeah, we had a good idea. We were going to have cost savings. We just didn't think we should have recognized that revenue, or we didn't want to do it until we were 100% sure. You don't have to wait until you're 100% sure. Just is it very likely that you will be able to capture that revenue? If so, adjust that total estimated cost. Don't wait until it's closed to recognize that revenue. If you have good reason to believe those cost savings are there, adjust it now. It'll help your financial statements, and it'll help provide a better picture of where that project is at. Just aside from the balance sheet and income statement analysis, 36% complete with the 950,000 versus 50% complete. We were really halfway through the project. This is the better approach. When you have good reason to believe there are savings or any changes, it could be the other way around. You may have more costs than anticipated. Update those estimates. Don't wait until it's closed to then say, oh yeah, well, this happened. If you're aware of it, change it at that moment. I hope that helped. I'll see you in the next lesson. Thank you.